Welcome to Dialogue. This conversation is part of a series we're doing on Trust the Experts, and today we're really focusing in on a group we could call tax architects.
And this is, I think, such an essential deep dive for anyone who's trying to navigate their career and, their finances today. The common understanding of taxes is almost childlike in its simplicity.
Right.
You earn money, the government takes percentage of it, and that money funds society. It's a very straightforward story we're all taught.
And it's what we're taught to accept. But that simplicity, you could argue, is a deliberate lie.
Oh, absolutely.
If the transaction is so simple, why is the instruction manual, the actual U.S. tax code, something like 80,000 pages long? And it's growing, with new regulations added all the time.
And why does that complexity require this whole priesthood of specialists, attorneys, lobbyists, accountants, all devoted to one thing, interpreting, and let's be honest, often exploiting those instructions? That's the real function of these architects of the tax labyrinth, isn't it? Their job isn't just about writing laws or ensuring compliance.
No, not at all.
Yeah.
They are writing belief. They are crafting a narrative. And that narrative is designed to perpetually justify a system that, well, it frames the very small group of people who hold most of the wealth as these indispensable engines of the economy.
Well, one's carrying society on their shoulder.
Exactly. While at the same time, these architects are engineering the legal mechanisms to make sure their actual contribution is as small as possible.
The contradiction is just staggering. We're told to trust these experts, the ones who get the rule book. Yet we're talking about a system so convoluted that the creators themselves, the architects, they end up in court arguing over what the rules they wrote even mean.
It's a kind of self-sustaining chaos machine. It really is.
So our mission today isn't to get into a debate about whether taxes should be high or low. That's not the point.
Right. We are here to unpack the deliberate design behind all that complexity. We want you to understand why the system looks the way it does. And we're going to focus on what is maybe the most important piece of that design.
Which is?
The crucial structural distinction between how income is treated and how assets are treated.
Okay, so to really unpack this, I think we have to start far back. Way back in history, when taxes were, you could say, brutally, transparently honest.
Maybe too honest for their own good.
Exactly. Think about an ancient civilization. Early taxes were just simple demands. You paid in what you had.
Physical resources, grain, livestock. Maybe you had to provide manual labor for a project or, a piece of gold or silver.
There was an absolute clarity to it.
Complete clarity. If you owned 10 cows, the government's agent would show up and say, we require 2 of them.
There was no ambiguity. And this is the crucial part. There was zero room for clever optimization by some specialists.
Right. No deductions, no credits. And definitely no arguments about whether that goat you just handed over could be depreciated over 5 years or 7. It was just a straightforward exchange of value.
But then at some point, someone realized they could structure the way things were collected to benefit themselves or their friends.
And right there, in that moment, the role of the expert tax planner was born. As soon as complexity gets into the system, the expert's job is created. And their job isn't just to collect the tax anymore.
No, it's to define the methods of collection.
Which historically were almost always designed to target the people with the least political power to fight back.
And the historical record is just full of these, absurd examples. They really show that taxes were designed to optimize collection from politically weak groups, not to optimize society.
These historical failures, they really set the template. They're the blueprint for how narratives are used today to justify putting unfair burdens on certain people.
Okay, let's look at one. This is where the pattern really starts to become clear. We can go to, say, 17th century England, the notorious window tax. It was introduced in 1696.
And the logic of the tax architects back then was, on the surface, beautifully simple. They thought more windows means more light, more glass, probably a bigger house.
Therefore, more wealth.
Exactly. So they taxed the number of windows on your house.
And it wasn't a flat tax per window, was it?
Oh, no. They designed it to scale up exponentially. The more windows you had, the more you paid per window. But the result was, well, it was inevitable and completely ridiculous.
Structural avoidance.
That's it. People didn't just pay the tax, they bricked up their windows. Homeowners, rich and middle class, they all did it. They decided avoiding the tax was more important than, having light and air in their homes.
Which led to these dark, poorly ventilated houses. It increased disease. It caused very real public health problems.
All because the tax spreadsheet somewhere in an office in London looked great. The numbers worked.
It's a perfect historical example of a modern principle, isn't it? When you tax a measurable proxy for something, people will just optimize against the proxy.
And it often comes with these really damaging side effects. That desire to avoid the tax created the first real market for tax optimization. Instead of an accountant, you hired a bricklayer.
What's another one?
Another classic absurdity was France's salt tax, the gabelle. It lasted for hundreds of years. Salt wasn't a luxury, it was a critical resource.
You needed it to preserve food for basic health.
Absolutely essential.
Mhm.
And by taxing this necessity so excessively, the government created a system where salt smuggling became a massive industry. It led to black markets, violent riots.
You're essentially criminalizing basic survival just to collect revenue.
The lesson from all these historical messes is that the complexity wasn't an accident. It was designed to find the path of least resistance for collection. Or, the path of maximum collection from the people who couldn't complain.
And this brings us to a really key evolutionary step in this story.
It does. The tax expert changes roles. They go from being a collector to being a storyteller.
The core question itself fundamentally changes.
It's no longer how do we efficiently fund the things society needs. It becomes how do we justify who pays? And even more importantly, how do we justify who gets a special exemption from paying?
The experts become the authors of that justification, the storytellers.
Which leads us right to what the sources call the first quiet shift. And I think this is probably the most critical insight for anyone listening who's building their career and their finances right now.
Okay, so what was the shift?
At some point in modern history, the tax system stopped asking, who has resources? Who has accumulated wealth? And it started asking a much narrower question.
Who has income?
Exactly. And on the surface, taxing income seems perfectly logical. You work, you earn, you should pay tax on what you earn.
But the switch is profound, and it's one that most working people never even notice.
If you're out there working a job, you live almost entirely on income. And that income is taxed loudly, it's transparent, it's automatic.
Withholding? You never even see a huge chunk of it. It's gone from your paycheck before it hits your bank account.
But the people we call the wealthy, or people operating at a very large scale, they live in a completely different financial reality.
They operate primarily on assets.
Assets. And assets appreciate quietly over time.
Yeah.
That growth, that appreciation is taxed very differently, often at much lower preferential rates. Or the tax is simply deferred until the asset is sold.
Which could be decades from now. And that's a huge difference, paying tax today versus paying it 30 years from now.
It's a world of difference. And this distinction, this lightly taxed, automatically withheld income versus quietly appreciating, deferred, preferentially taxed assets, this is the foundational design principle of the whole modern tax labyrinth.
It creates two separate economic realities from the very start.
And two separate effective tax codes.
So let's jump from the 17th century to now, the 20th and 21st centuries, where that initial quiet shift just exploded into this 80,000-page monster we have today.
And the core claim here is, well, it's pretty startling. The tax code doesn't grow organically like a tree. It bloats intentionally.
That's the operating principle you really have to internalize, isn't it?
You do. Complexity is camouflage. It's a dense smokescreen. Think about it. If the tax rules were simple, if they were transparent, if an average intelligent person could understand them,
Then everyone would have to play by the same rules.
but when the rules become so dense that only a highly paid specialist can interpret them, and only a highly motivated group can afford to hire those specialists, well, the people who write the rules or influence them, they win every single time.
And that leads right to this core idea that when we talk about loopholes, we're not talking about some kind of mistake.
No, they aren't bugs. They are fundamentally features of the system.
We have to get rid of this naive idea that a tax loophole is some forgotten clause that a clever accountant just stumbled upon one day in a dusty old book.
It's not like that at all. These mechanisms are systemic engineering. They are aggressively lobbied for by huge organizations pouring millions and millions of dollars into policy advocacy.
They're drafted by specialized attorneys, the architects.
And they are inserted quietly into legislation. Sometimes it happens late at night. Sometimes they're buried deep inside bills that have nothing to do with taxes.
And then only after the mechanism is installed, it gets announced to the public. And it's always, always wrapped in a justifying story.
A bedtime story, source material calls it. The narrative has to protect the complexity.
So what does that narrative sound like?
It's always positive. It's always, this helps innovation, or this creates vital jobs in the manufacturing sector, or this stimulates necessary growth. The stated goal is always some great benefit for society.
Even when the immediate measurable result is just sheltering hundreds of billions of dollars in otherwise taxable wealth.
And the consistent message whispered to the public is always the same. Leave the complexity to us. It's too complicated for you. Trust the expert.
Okay, let's break down some of these modern mechanisms with concrete examples. This is where the camouflage really becomes visible. Let's start with one called accelerated depreciation. This is a huge tool for good companies.
It's massive. So traditional tax accounting says you have to depreciate an asset. Let's say it's a $10 million piece of factory machinery, slowly, over its useful life. Maybe that's 10 years.
So you get to claim a $1 million deduction each year against your income.
Correct. But accelerated depreciation lets a company claim a much, much larger percentage of that asset's value as a loss and do it way sooner than the machine actually wears out.
So instead of $1 million a year for 10 years, what does the architect allow?
They might allow 50% or in some cases even 100% of the cost to be deducted in year one,
Wow.
which means the company generates a huge paper loss right up front, $10 million, which can then be used to offset real taxable income in that same year.
And this gets to a core concept in finance, the time value of money.
Absolutely. A dollar of tax deduction today is worth far more than a dollar of deduction 10 years from now. So this isn't about avoiding the tax forever. It's about delaying it, pushing it decades into the future.
And that frees up enormous amounts of cash right now that should have been paid in taxes.
Delaying a tax payment is almost as good as eliminating it.
Okay, let's look at another one that's particularly relevant to Wall Street. Carried interest.
This is a textbook example of what we can call income reclassification. It's financial alchemy. Imagine a private equity fund manager. She earns, say, $5 million in compensation for managing the fund.
Okay, if that were my salary, that would be ordinary income.
And it would be taxed at the highest bracket, maybe 37% federally, plus state taxes. But if they structure their compensation as carried interest, which is framed as a share of the fund's long-term investment profits, that $5 million is suddenly not salary anymore.
It's reclassified as a long-term capital gain.
Which is taxed at a much, much lower rate, often closer to 20%. So just by changing the legal label on the money, the government's share of that $5 million drops from, roughly $1.85 million to $1 million.
A huge difference. The work being done is active management, but the tax treatment is for passive investment.
That is complexity designed for one thing, a preferential outcome.
And then things get even crazier when we go international. Offshore profit shifting and transfer pricing.
Now we're in the deep end of the pool. This is corporate financial magic. Take a big multinational firm, we'll call it Global Widget Corp. They develop their key intellectual property, let's say it's a software algorithm, in the high-tax U.S. where all their expensive engineers live and work.
Right.
Global Widget Corp then sells the rights to this incredibly valuable IP to a tiny subsidiary that they themselves own in a tax haven like Ireland or the Cayman Islands.
And
They sell it for a surprisingly low price.
almost nothing. Why does that matter?
Because now the Irish subsidiary owns the valuable IP. So when Global Widget Corp sells its products back in the high-tax U.S. market and makes billions in profit,
Let me guess.
the Irish subsidiary immediately turns around and charges the U.S. branch massive, exorbitant royalty fees to use the IP that was developed in the U.S. in the first place.
And those fees are so high, they basically zero out the taxable profit in the U.S.
Precisely. And suddenly all those billions in taxable profit magically appear in the Irish subsidiary, where the corporate tax rate is near zero. The profit is physically shifted without a single widget ever crossing a border.
And the list just goes on and on. We see things like loss harvesting, where investors sell off losing stocks at the end of the year to cancel out their big gains.
Right, and then they often buy a very similar asset back just a month later, or the explosion of pass-through structures. These were originally meant for, small mom-and-pop shops to avoid being taxed twice.
But now they're used by enormous businesses.
The architects have expanded their use. Now, owners of huge, profitable firms can route their profits through these structures and take big deductions, like the qualified business income deduction.
Oh, so they're getting tax advantages that were designed for Main Street, not Wall Street.
It effectively lowers their personal tax rate far below what a high-earning employee with a regular paycheck might face. The income earners are trapped. The asset owners have engineered an escape hatch.
When you put all of these mechanisms together, the overall effect is it's like upside-down gravity.
That's a great way to put it. Instead of wealth contributing proportionally to the system that makes it possible, the system is actively designed to let that wealth be reclassified, relocated, shielded, and hidden.
All while the vast majority of people, the employees, the wage earners, are operating under completely different, much stricter rules.
Their income is loud, it's transparent, it's automatically withheld, they have a massive compliance burden, and they have zero lobbying power to change the 80,000-page rulebook.
So this brings up the most important question, the one the architects always try to bury. If all this concentrated wealth is systematically reducing its contribution, who pays the bill?
Because the bill doesn't just disappear.
Who pays for the roads, the courts, the military that protects all those assets?
It is redistributed downward.
Mhm.
That is the central structural purpose of the tax labyrinth. When large corporations and wealthy individuals use this complex engineering to lower their contribution, that revenue gap has to be closed somewhere.
And it gets closed by taking the path of least political resistance.
Always.
So how does that gap actually show up for the everyday person who's already paying their income tax, their payroll tax?
It hits you indirectly.
Yeah.
In ways that are often much more regressive. Think about it. Your local government has a budget shortfall because a big corporation got a huge tax incentive. What do?
Sales taxes go up.
Exactly.
Yeah.
Which makes everything more expensive for everyone, regardless of their income. Payroll taxes, for things like Social Security and Medicare, they stay fixed, and they hit lower and middle incomes much harder as a percentage of what they earn.
And then you get all the fees, property taxes go up, tolls, utility surcharges, licensing fees. They just multiply.
So the general population isn't just paying their own share of taxes. They are actively paying to fill the structural revenue gap that's created by large-scale engineered avoidance higher up the economic ladder.
That is the core insight. A system designed this way forces compensation and therefore hardship onto everyone else.
It's not a bug. It's the designed outcome of all this complexity.
Which brings us right back to complexity being the ultimate shield. The very density of the tax code gives everyone plausible deniability.
Of course. The CEO or the fund manager can stand up and say with a straight face, we are not doing anything illegal. We are just following the law.
But we always have to remember the crucial caveat to that.
It's the law. They pay the architects millions of dollars to write for them, perfectly tailored to their needs. Complexity is the armor that protects this whole system from any real public scrutiny.
Okay, let's just set aside all the narratives and the complexity for a second and just look at the basic math. We need to ground this in what proportional participation would actually look like.
Right. Without getting into ideological arguments about punishment or redistribution, just the numbers.
Let's use a simple model. Let's say the total national income, all the taxable economic activity in a year is $100.
Okay, a $100 economy. And let's say the government needs $20 from that to operate, to pay for everything it currently does.
So a 20% effective tax rate across the whole economy.
Now, we have to overlay the reality of wealth distribution. The sources are pretty clear that the top, say, 10% of corporations and individuals control roughly 70% of the nation's wealth and economic gains.
And the bottom 90% of us share the remaining 30%.
And that disparity is the whole context. The bottom and middle pay their share through very visible, immediate ways, income withholding, payroll taxes. The top uses the camouflage we just talked about.
Asset classification, deferrals, offshore shifting.
Right. So let's define fair share not as some political idea, but just as proportional contribution.
Yeah.
If the top group controls 70% of the economic activity that made that $100, they should contribute 70% of the $20 that needs to be collected.
The math on that is pretty simple.
It's non-negotiable. 70% of $20 is $14. That's what the top group should contribute.
Which would leave the remaining bottom and middle 90% to cover the other $6.
That is proportional participation. Simple as that.
Okay. Now for the current engineered reality. Because of all these avoidance mechanisms, the top group actually contributes something closer to $8 or $9.
Which leaves the bottom and middle groups to cover the rest. So instead of $6, they're covering $11 or $12.
And this is the critical missing gap, that $5 or $6.
That revenue doesn't just disappear from the system. It is extracted from the everyday population. But it's done through these indirect ways that don't feel like a tax. They just feel like economic stress.
What do you mean?
It's things like higher rents because of speculative real estate investment. It's exorbitant interest payments on debt. It's consumption taxes, higher sales tax, sin taxes. It's the constant pressure of inflation caused by this unbalanced fiscal system.
So that missing $5 or $6 isn't a check you write to the government. It's captured from you indirectly by the system, and it flows upwards through all these perpetual expenses.
It's a hidden tax on just existing in the economy.
So let's do the mental exercise. What if we eliminated those structural avoidance schemes? What if the top wealth segment was actually required to pay its proportional $14?
And the bottom and middle were required to pay their proportional $6.
We still collect the $20. The government is funded exactly the same.
But the burden on the bottom and middle earners drops from that $11 or $12 all the way down to 6.
That's a massive reduction, a 45 to 50% cut in the total tax burden on everyday working people.
And this is the staggering implication for you, the listener. If the average worker today faces a really high total effective burden, and we're talking federal income tax, payroll tax, state tax, sales tax, property tax, all the fees.
Let's say it all adds up to around 40% of their total economic output.
So if you're making $80,000 a year, 32,000 of that is effectively vanishing into funding the system through all these different channels, direct and indirect.
Okay.
But if you eliminate that structural avoidance, that gap that the middle class is currently forced to fill, it could plausibly bring that worker's total effective burden down into the 22 to 25% range.
And that massive reduction happens without cutting a single public service.
Without increasing the national deficit.
And without punitively raising tax rates on anyone.
It simply requires ending large-scale, engineered avoidance and forcing proportional responsibility.
What's so striking about that is that the math is straightforward. It's not extreme. It doesn't require any radical ideology.
It's a mathematical question, not a political one.
Which brings us back to the central mystery. If the simple proportional math offers such a profound benefit to the vast majority of people, why on earth is the system designed to be so complicated?
Because the complexity serves a structural purpose. It has to. It hides the upward redistribution of wealth and makes the shifting of the burden completely invisible.
It requires the architects to constantly interpret reality for the rest of us.
Think about it. If the average person saw the simple arithmetic, that they are paying 40% so someone else can pay 15%, the whole argument would shift. It would stop being a debate about ideology, and it would become a demand for simple, proportional fairness.
And that is why the expert class insists with so much passion.
It's too complicated for you. Leave it to us.
And that complexity needs a powerful story, a powerful mythology to survive any kind of public scrutiny.
And the most durable myth in modern economics has to be the concept of trickle-down economics.
Ah, yes, the famous bedtime story for adults.
That's the one. The idea that if we just reduce the tax burden on the wealthiest people and the largest corporations, that money will automatically flow down, it'll benefit the masses, it'll stimulate hiring, it'll increase wages.
But the reality, which has been documented over and over again, is that wealth doesn't really trickle down. It pools, it accumulates.
And it reinvests primarily into ownership, into buying more assets, into cupping stock buybacks, into controlling interests in other companies, not necessarily into hiring more workers or raising wages for the general workforce.
And that ties right into the second big myth that the architects use to justify this preference for capital.
The job creators myth, the idea that corporations are primarily in the business of creating jobs.
The narrative is that corporate tax breaks lead directly to these big hiring sprees.
But if you look at the core driver of modern corporate behavior, what is it? It's maximizing shareholder value and efficiency. The mission is consolidation, it's cost reduction, it's maximizing output per unit of labor.
So jobs are often a necessary side effect of market demand, but they're not the primary mission.
Efficiency and automation are the mission.
The standard economic story is this very misleading one-way flow. Capital gets invested, corporations create jobs, money flows down.
And everyone else is just a passive recipient of corporate generosity. But that completely ignores the reality of mutual benefit.
Right. Yes, capital matters, investment matters. Nobody is denying that. But corporations don't operate on Mars.
They benefit upward from all the societal contributions that everyone else pays for.
They need educated workers who probably went into debt for their own schooling. They absolutely rely on our infrastructure, the roads, the power grids, the data networks, which are funded by public taxes, including yours.
They depend completely on a predictable legal system, on courts and regulators to enforce their contracts and protect their property rights so their assets are safe.
And most fundamentally, they need a large, solvent population with enough purchasing power to actually buy their products and services.
So the general population isn't a passive recipient of charity. They are the co-creators of all wealth. through their labor, their consumption, and the taxes they pay to keep the whole structure of the market stable.
But the tax narrative tries to strip workers of that dignity, of being co-creators. It implies that corporations are giving jobs or giving wages.
They're doing neither. They're exchanging wages for value, for skill, for time, for productivity. It's a mutual exchange. If the entire workforce vanished tomorrow, the corporation would cease to exist no matter how much capital it has.
But by framing only capital and investment as the indispensable ingredients, the architects justify a system that puts a higher effective tax burden on labor, your income, and a much lower burden on capital.
It's a design narrative to maintain that imbalance.
And here's the ultimate irony in all this. We are constantly told that wealth trickles down. But if you just look at the fundamental mechanics of the economy, for most people, money reliably, structurally trickles up.
Through perpetual obligations.
Yeah.
It's a mandatory upward flow. Rent payments, interest on student debt and credit card debt, fees for every single transaction, exorbitant healthcare costs, subscriptions for everything. This is a continuous upward transfer of wealth that's required just to function.
And that upward flow, the rent and the interest and the fees, that's never called a contribution to the system, is it?
No, only the capital class gets to claim that honor when they benefit from a tax break.
And this entire economic balancing act, the story they've been telling, it seems to be reaching a critical tipping point now, and it's being driven by technology.
The huge tipping point. For decades, the political justification for low taxes on capital was always the same. It provides the incentive for companies to hire more people.
But AI and advanced automation have just completely exposed that core premise as outdated. Maybe it was always false, but it's definitely false now.
Companies are now actively downsizing. They're replacing entire departments, legal, marketing, engineering, and they're scaling their output with dramatically fewer human workers.
AI is the perfect corporate instrument, in a way.
It is. It doesn't need healthcare. It doesn't demand breaks or complain. It certainly doesn't form a union. And it requires no personal tax withholding. The entire exchange has shifted. Companies can achieve massive scale and efficiency without the primary cost driver of the last century, which was human labor.
So what happens to the tax base when the labor component shrinks, while corporate profits skyrocket because of all these new efficiencies, and the taxes on those profits remain structurally optional because of the labyrinth we've been talking about?
The tax base collapses. It has to.
Yep.
If the primary revenue engine of the state is the automatic, loud taxation of labor, and labor is rapidly being replaced by automation, then the state is functionally bankrupting itself over time.
The structural justification for taxing labor so heavily just evaporates.
It completely vanishes. And the new structural question becomes this. If corporations no longer need a huge workforce to scale their operations and generate massive profits, why should the remaining workers carry the primary tax burden?
The corporation still relies on the roads, the clean water, the energy grids, the courts to enforce its IP rights.
And the consumers the state protects. This massive shift reveals this structural, almost existential need for simplicity in the tax code.
And this brings us to the argument for a radical simplification, something like a flat tax or a similar broad-based system.
Right, and not as some kind of ideological victory for one side or the other, but as a mechanism for the structural survival of the state itself. That's the argument in the source material.
So explain that. Why is simplicity in this context a structural necessity?
Because a simple system, one that is broad-based and applied consistently to all economic activity, is fundamentally harder to avoid. The exceptions and the loopholes just disappear.
It's harder to lobby around because the rules are transparent for everyone to see.
And it becomes exponentially easier to enforce because the base is so much broader. It captures wealth and activity no matter how it's labeled, whether you call it income or an asset gain.
It's a mechanism that redistributes burden, not wealth.
Exactly. It forces proportional participation from all the economic actors. It ends the gatekeeping power of the expert class by making the rules visible to everybody. And it collapses the entire tax labyrinth overnight.
And that is exactly why the architects of the tax labyrinth and the interests they work for resist simplicity with such extraordinary force.
Of course they do. Simplicity makes them obsolete. Their entire specialized relevance, their whole industry, depends on the continuation of this engineered chaos, where only they hold the keys to the 80,000 pages.
A simple system just exposes all the narratives. It reduces the ability to manipulate things because the proportional math becomes visible and undeniable.
And the architect's constant insistence that it's complicated, it must be complicated, is the final, desperate defense for their own relevance and for the continuation of this structural burden shifting.
So we started this deep dive by acknowledging just how overwhelming the tax code is. And I think we were all raised on the idea that complexity equals intelligence.
That experts are neutral and that the financial outcomes we all experience are just the fair result of an equitable system.
But the history, the structural design, and the actual arithmetic we've walked through, they all show the opposite.
Complexity protects entrenched power. The experts serve the incentives of the people who pay them to write the rules. And the systemic outcomes, the fact that the burden falls so disproportionately on your immediate earned income rather than on quietly appreciating assets, that was meticulously designed.
The tax code isn't broken.
No, it's working exactly as intended by the architects who built the labyrinth around capital, and in doing so, forced the rest of society to make up for the engineered gaps.
So, the next time someone in a position of power or on some specialized panel tells you, trust the experts, you should be ready to ask 3 clarifying questions about these architects of complexity. Which experts are you talking about? Who funds their work and pays their salary? And who benefits most from the complexity they insist is so necessary?
Because that distinction, the one between loudly taxed income and quietly appreciating assets, is the single most important key to understanding your own financial situation and the powerful unseen forces that are shaping the economy all around you.
If you enjoyed this conversation, please like, subscribe, and share this video. Also, let us know in the comments what really stood out to you in this conversation, and if there's any related topic or a new topic that you would like covered in a future video.